Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show. Jeff Bernier here. Great to have you with us. Always good to be with you and be able to share some information that I'm hoping will be helpful to you as you try to create a life of meaning and purpose, and you put the financial plans and the wealth management strategies in place to give you the capacity to go live the life that you're called to live. And I'm excited about my guest today, so let me just jump right in and introduce him. So I've got on today Rubin Miller. Rubin is the founder and chief investment officer at Peltoma Capital Partners. Rubin has over 20 years of investment experience. He started as a commodities and fixed income trader at the Chicago Board of Trade. He was a regional director at Dimensional Fund Advisors. You're all very familiar with Dimensional from some of the work in the past shows. Most recently, he was a partner and senior financial advisor and ultimately chief investment officer at Perspective Wealth Partners. Rubin founded Peltoma Capital back in 2023 to help show people that there's a better way to invest. And I'm sure we'll talk a little bit about that. I found Rubin through his writing. He's a prolific writer. He has a fantastic blog called the Fortunes and Frictions blog, which is now he's got readers in 125 countries. And he was even endorsed by Jason Zweig, who is one of my favorite journalists at the Wall Street Journal. So without more puffing up, Rubin here. Hello, Rubin. Thanks for joining me, man.
Well, howdy. Thank you for having me.
Yeah, great to have you on. As I mentioned, when I set up the show, it's kind of informal and we're all about money and meaning and living a fulfilling, meaningful life. And so to start, I almost always like to hear a little bit about you personally. So tell me, if you don't mind, just a little bit about yourself and your family and kind of how you got here.
Sure. Yeah. I live in Austin, Texas. I'm originally from Dayton, Ohio. I'm from a big family, one of 5 kids. We're all kind of spread out a lot. And I landed in Austin, as you shared a little bit. After college, I went to Chicago and I worked at the Board of Trade. Finance looked a lot different back in the mid-2000s and into the teens.
Right.
Proprietary trading, hedge funds, things like that. There was a lot more like a cowboy culture around a lot of corners of finance, and I worked there. I'd call it in one of those corners for a while as a bond trader. Everything kind of moved to screens the way we live now, but it wasn't that way even in the early mid-2000s when I graduated college. People were still in trading pits and things like that. But when things moved to screens and the actual day-to-day job evolved, I didn't love staring at screens all day and kind of not talking to people as a trader. So I just kind of wore out, not necessarily from the content of my job, but the day-to-day of it. And so I decided to go back to business school. I moved to Los Angeles for a couple years of grad school. And then I stayed, as you mentioned, I worked at Dimensional, who's got everyone's favorite satellite office out there in Santa Monica. And that was fun.
Oh, you did? Yeah.
And then during COVID, right before COVID, I moved to Austin. Everyone else moved to Austin during COVID. I moved right before. And I still worked at Dimensional for a little bit. And then, as you mentioned, I went and worked at a different RIA as chief investment officer. And a couple years ago, I hung up my own shingle, and that's been really great. So I work at this firm called Peltoma. There's 3 of us. I believe you've had my partner on before on your show,
Levine,
who's the impressive one of the 2 of us. And then we also have a third colleague, Emily Moran, who joined us. She also worked at Dimensional, joined us beginning of this year. So we have a little kind of nice boutique. We work for about 50 families and a couple institutions out here in Austin. And the personal side, I'm a single dad and I have a 2.5-year-old daughter.
Oh, wow.
Yeah. So I'm busy. Wow. Yeah.
I'll bet you do. Yeah. Well, Austin's a great city. I love visiting there. When I come see my friends at Dimensional, or I'm a Bulldog here in Georgia, so I came to to the Texas game earlier this year and brought my son.
Oh,
We
nice.
had a great time. So
Yeah, sure.
Austin's a lot of fun. But yeah, and I noticed in your bio. So tell me, you were a chess master, or you won the chess master title at 15. So tell me about that.
Yeah.
What does that mean?
The chess master title is you get that from a rating. So if you play in tournaments, as was a big part of my childhood, you get these ratings, and so it's a level. It's the rating of 2200, and then you get that title. There, it goes up progressively. A lot of people are familiar with the term grandmaster. I guess the one thing worth knowing is the difference between a low-level master like myself and a grandmaster. The difference is a lot.
Right.
So I'm not that, but yeah, I had a childhood of playing a lot of chess, and I wouldn't say I am necessarily naturally as gifted as many of my peers, but I was able to get to that level fairly early on.
Yeah. So you've always been, I don't know if logic or strategy or thinking ahead. I mean, obviously, those are skills that I'm sure have served you in your investment career or other areas of life, perhaps. The other thing I noticed on your website, on your new company, 23, it's not that new anymore, but Whitefish, Montana, we were just talking about that. So Peltoma is a national firm. You got the three of you are scattered around the globe, or you just you're sort of a virtual type firm, or is everybody in one place in Austin?
So I would call us a digital forward firm as far as the way we interact with clients. When I set expectations for a relationship with clients, I tend to tell them they usually don't live in Austin. So most of our clients are in kind of the larger cities in the U.S.
Okay.
And we'll tell them, I'll get to the Whitefish part in a second. We'll basically tell them that, I don't know how you feel, Jeff, but financial planning conversations, if I'm going to open up financial planning software, it's actually really, it's a really nice exercise to do via Zoom, because you can look at your screen in the comfort of your home.
Share everything.
Share screen, toggle things, scenario analysis. You don't need to be in person. But if you never meet in person, how much does someone trust you over Zoom? That's the other side of that coin. So for us, we always tell people, like, we come to your city, you live in San Francisco or New York or Chicago, we will be there a few times this year. And when we get there, I want to go on a walk with you or grab a beer with you or a coffee, and I want to hang and know you. I don't want to talk about whether you're going to retire at 64 or 59.
Yeah, you can do that over
We can do that over Zoom. And I assure you, it's better over Zoom, because you can look at the screen in the comfort of your home with your spouse there. So we've just found that we're a national firm in the sense of the footprint of our clients. We're somewhat localized in the sense that Rachel and I live most of the year here in Austin. Emily lives in Charlottesville, Virginia. And then I spend some of the year in Whitefish, which is where my mom is from, that area. So I've always kind of grown up going there. Yeah. And then Rachel actually has a place in Park City, so she spends some time there as well. And I think what's changing about wealth management in a firm like ours, I think we're a little different probably in a firm like yours, in that our client base skews a bit younger.
Okay.
We kind of focus on what we call high-performing professionals. So people in their 30s, 40s, 50s, 60s. We do have older clients, but those are often people that just like really wanted to work with us, knowing that maybe they don't fit our wheelhouse. But we like the complexities of people who are sort of time impoverished, busy lives, and they're like, just come create a flywheel for my financial life so I don't have to think about it anymore. And then we come in with the planning and wealth management expertise around, here's all the tax benefits that are available to you, here's the accounts we need, here's how we're going to run this thing, and you go live your life and we'll take care of it. Yeah, so it's digital first, and then we try to see families like that in person. To be honest with you, I found a lot of people don't even really want to meet in person that much. Maybe they probably do with my other colleagues, but maybe just not with me. But that's
no,
fine
I doubt
too.
it.
That's fine too.
Yeah. Well, Austin's traffic's not that different than Atlanta's. I've got clients that are 3 miles away that would still rather do a Teams meeting than come to the office occasionally. So
I don't know
get
about
it.
Teams, but maybe Zoom.
Or Zoom, Teams, whatever. Yeah. We've all had to learn this stuff. Hey, so this show, I try to, as I mentioned, it's about money and meaning, and so one of the things that we try to talk about is, what is our purpose? So, without getting too nosy here, what gets you jazzed, either personally or professionally? What gets you excited even about the work that you do. What is your why, if you will?
I care a lot about non-wealthy people. As a wealth manager, I don't really care if people have money. So one of the challenges of my career has been this sort of empathetic side I have for people that don't have means and are just trying to sort of make ends meet. And this expertise that I have developed through schooling and credentials and all that, which tends to be focused on making wealthy people wealthier. And so I've had this friction between what I care about and what I would say maybe how I'm differentiated. So one of the things I love about having a blog, the way we run our firm, initiatives we have, time we give away, is that there are ways for quote unquote wealth managers to not just serve wealthy people.
Right.
And I think that that's an important thing, frankly, to look for if you explore hiring an advisor. Like if you
I agree.
If you can figure out that what makes an advisor tick is hanging out at the yacht club with just rich people, making rich people richer, like that's fine, but like that's not my thing.
Right.
Writing has been a really great outlet for me to distill basic investment concepts that are available to the masses. My blog is free to read, and the content is intentionally geared toward to be palatable and understandable for non-investment people. So I would say what my why is, or what makes me tick, is broadening the ability for people who aren't yet wealthy to maybe get access to the basic ideas. And the cool thing is that because of the state of financial engineering, which gets a really bad reputation when you think about 2008, 2009, but should get a really great reputation when it comes to low-cost funds that are now available for basically free that anyone can invest in, because people have been able to lower the cost of creating these things through technology. So financial engineering has allowed us to be in this place where I would tell you, someone with no money can start creating this flywheel, get the right account set up, really, really low friction experience. And I love the idea that that wealth management is evolving to not just be wealth management, but wealth creation, and distilling the ideas of how to get there for people.
Oh, I love it. Yeah.
Thanks. Yeah. I mean, like your firm, we have a very specific investment philosophy, and it has nothing to do with how rich you are. Barriers to access have been broken down, but barriers to advice haven't necessarily, because you still will meet a lot of advisors who don't really want to talk to you if you don't have money. So I would say, on one end, the super empathetic side of me says, this is bullshit and the industry needs to change. We cannot just serve wealthy people. The other side of me says, this is a business. You can't be everything to everyone, right? You and I can't give an hour to everyone that wants to talk to us. So I feel like the thoughtful way to design a firm, and the way we've decided to run our firm, is know who you serve them really, really well, but also realize that we must have a bigger purpose. I mean, we're so fortunate to work in this industry. What can you offer broadly, whether it's, well, at least anyone that reaches out can get 20 minutes with an associate advisor, or maybe a half hour, whatever it might be. Or we created these videos for you, for anyone to watch. This is what we would do, but don't hire us because you're not a good fit. Whatever it is that you're going to offer the world, do it. But I really do think that we need to evolve away from having websites and unapproachable brands where it seems like we're only for rich people. Maybe our core client, maybe our expertise is around rich people, but what else are we doing? And if I were searching for an advisor, I would look for that. Like, that tells you a lot about who you are.
Yeah. Well, I know I had a consultant, and you've probably heard this term as well, talk about going 10X, and I said, I don't know if I'd be happier at 10X. I'd love to go 10X influence. Like, I'd like to grow my influence 10X and help more people who will never be prospects for my firm or your firm or other firms in terms of our day-to-day activity, but you can influence them. And your blog, you're right, I think is a fantastic way to do that. And the podcast and, books and other things that you can put out to the world. So that's cool. Well, let's talk about your investment philosophy. Can you give us your firm's investment philosophy and in a few minutes, kind of what are the sort of the foundational pillars of the way you manage money?
Yeah,
Which
sure.
it sounds like is appropriate for everyone.
Yeah, I mean, I think at its basic core is the stock market, the bond market. These are just markets. And we're all familiar with markets, grocery stores, stores in general. We've shopped for real estate before, whatever it might be. Like, we're familiar with the marketplace. And for me, just the way I operate in life is like markets have to work or otherwise something's got to change. So if you go to a grocery store and you see the price of a box of cereal, if that price is priced too high, then no one's going to buy it. The grocery store is going to be mad at the cereal brand. They're going to have to go figure out something and change it. If the price is too low, everyone's going to buy it. The cereal company is going to make no profits, and then they're going to have to change something. So in markets that have competitors and have buyers and sellers, like the price, the phrase I like to use is the price has got to clear, which is a phrase I stole from David Booth at Dimensionals. The price has got to clear, right? So
where buyers and sellers can come together and agree.
Yeah, there's got to be a handshake, and not a physical handshake, but we're always making handshakes, right? At least in a non-physical sense.
Right.
So markets have to work like that. And the stock market or the bond market is really no different. I mean, when you make a trade, there's a buyer and a seller and it clears. And they're both willing buyers and sellers. So to me and our firm, there's a lot of information in that because nobody's trying to lose money. So there's going to be, informed people on the buy side, informed people on the seller side, and they're going to meet and the price is going to clear. And I would tell you, my first guess is like, that's probably a pretty reasonable price then. And if you look at the data we have for 100 years of investing, we know a lot about what to expect, whether you're a stock investor or bond investor, the type of portfolio maybe you should build. And it does seem like prices are pretty fair. Now, stocks are very noisy. So when new events happen, prices change. I think probably where we differ from a lot of retail investors and some advisors would be that I see price changes as new information coming out, impacting the future trajectory of where things go. A lot of people see prices change and they say, oh, shoot, I should have bought it. Or, oh, shoot, I should have sold that. I should have known that. And I would say it's mostly unknowable things. So what you really want to do is spend time designing a process, which includes portfolio design and an implementation strategy, and reduce the regret you have over seeing future events where you say, oh, shoot, I really could have done this historically and that would have worked out better for me. Like, you can always say that about something.
Right.
So that's a basic pillar of our investment philosophy is that markets work pretty well. We're always going to be able to look backward and wish we had done something. But as far as, doing the most you can with the information you have at the time and making high quality decisions, I would say 100 years of data and 60 plus years of financial research at leading institutions from Nobel Prize winners would tell you, diversify your portfolio, keep your fees low, and keep your tax drag low. And that is the basis of our philosophy. Is it easy to implement? No, it's not easy to implement because I talk to people every day that aren't doing it. Really, really smart people that aren't doing it.
Right.
You need an advisor to do it? Also, no. Can it be helpful? Sure. I don't make assumptions about other people's investment journeys until I talk to them and see what they have going on. But what I would tell you is as basic as our philosophy is, which I think, and I'm sure your firm agrees, is the best way to accomplish the outcomes that you want as an investor, the highest probability of success. A lot of people get in their own way because the timeline on which financial research has been done about how the best possible investment experience is many, many decades. And so the inputs that you have, the portfolio design, is based on, call it 20, 30 plus years that you need for that to play out properly. And before that, a lot of it is just noise. And what so many investors like to do is see a short-term outcome, like something over 1 month or 3 years, or might be, and say, oh, look, I did a great job, or, oh, shoot, I should have done that like my neighbor did. And it's like, actually, that's pretty random. Just like the future unraveled, events occurred, and moved portfolios that way. It doesn't mean that right now you know what to do next. It just means there's always going to be some randoms. Over long periods, I do think that It helps to have a super thoughtful and well-engineered process. Over short periods, almost everything is random.
Yeah. Yeah. My friend, who I'm sure you're familiar with, Larry Swedroe, he says that 5 years, investors think 5 years is a long term and 10 years is the eternity. And in the data, it's kind of noisy. I mean, 10 years is even pretty noisy, when you look at look at the long-term data.
I don't really care about 10 years.
Yeah.
So there's a famous academic, Ken French, who is known for his database and library of data. And he's done some things about statistical significance on someone who picks stocks, being able to tell somebody after they outperform, like, see, I'm really good at picking stocks. Well, obviously that's random. You buy or you sell and it's going to go up or down. You're right or wrong. Like, it's easy to do one and be right because it's going to happen, roughly half the time. But if you look at statistical significance and say, is there information in this that gives me reliable data to move forward and say, oh, this person is reliably good at that I'm willing to give them my money, and going forward, I expect them to outperform. And it's 85 years on a typical alpha creation or outperformance and the traditional standard deviation that comes alongside that. So when you are a statistician, call it 85 years, call it 60 years or 40 years, none of those are on the timeline that investors care about.
So in other words, sometimes it takes that long to know if it was skill versus luck.
Exactly. On a statistical significance basis, which actually just means 19 out of 20 times anyway. It could still have been noise or random. So needless to say, again, whether it's 85 or 60 or 40, there's different inputs. It is not 5 and it is not 10. And so the timeline we have as investors is not the same as we have on research about investing. And the truth is academics don't care about you. They don't care that that's not your timeline. That's how the world is. That's how investments work. So you can either come to that and make it a part of your journey, or you can keep putzing about confusing luck with skill.
Very helpful. Yeah. So when you talk about the relatively efficiency of markets and markets clearing, it sounds like you don't try to outguess the market by forecasting or market timing. You capture the market results in a reasonable way, it sounds like. Low cost, tax efficient, be thoughtful about how you allocate capital to capture those premiums. How do you decide, if at all, how far you drift from just owning the market portfolio? So if the market portfolio is defined as what everybody owns in the aggregate, that's the total market. How would you decide how far to deviate from that, if at all?
Yeah. You don't have to, I would say. The cool thing again about financial engineering is you can now buy an index that's going to own a little bit of almost every stock across the whole world, and it's going to be close to free.
Right.
I think on $1,000 investments, you can get that kind of portfolio for 40 cents a year. I mean, it's
right.
Nothing.
It's ridiculous. Yeah.
You don't have to. There are people who believe that you should. And this comes down to this question, do I think all stocks are created equal? Or do different profiles of stocks have different, what we call expected returns? And I think that it is fair to think, and I do believe that not all stocks are created equal, right? Certain stocks are probably riskier than other stocks. If you ask me, do I want to go buy the stock in Buffalo Wild Wings, some chicken wing restaurant, or Apple? I can tell you, Apple's a way better company. It's better run. It's more robust, more profits, smarter, I'm sure. It's a way better company. But in a market that works well, the market knows that, right? Which is why the price of Apple as an entire company is probably around $3 trillion. And the price of Buffalo Wild Wings is, I don't know, call it 200 million or something. It's a fraction of what Apple is worth, right? So if I have $1 million, I get to own way more of Buffalo Wild Wings than I do of Apple. And that, to me, that's the market working. That's what it should do. Now, which one is more likely to go bankrupt in the next 5 years? I would tell you Buffalo Wild Wings.
Right.
So I would tell you that investors, if you have to put $1 million in one of those two things, you would, if I told you you're going to get the same return, You would say, well, I'm going to put it in Apple then. I sleep way better at night knowing that the leadership and brains that run Apple and all the great products, it's better than chicken wings.
And all the cash on the balance sheet and positive cash flow. Yeah.
So what's that mean? It means that if I'm going to go put in Buffalo Wild Wings, I better damn expect a higher expected return than my $1 million in Apple. And I think that makes sense to people. However, that's not really how people invest. Most people, when they have money, they go buy cool companies that they know about, that have flashy toys and great leadership and all that. In reality, in a market that works, riskier companies should have higher expected returns, and investors should demand higher expected returns for owning them. Otherwise, we'd all just go buy really nice companies. So it is true that not all stocks are created equal. I believe that. And if you overweight companies that have the profile of a Buffalo Wild Wings, I expect you to outperform compared to a portfolio of Apples. That doesn't mean I want to work at BW3s instead of Apple. I'd rather work at Apple. I'd rather be an executive leadership at Apple. I'd rather have RSUs from Apple. All these things. However, if I'm an investor, I have the choice of where to put my $1 million. You got to expect higher expected returns from Buffalo Wild Wings. Here's what's cool, is that that's worked out. We have 100 years of data to say, hey, what is the return of buying small, crappy companies versus high-flying, really profitable, nice, large companies?
Yeah, if you diversify away the idiosyncratic risk of the one company.
Thanks for mentioning that. That's a big part of it, owning the basket of them.
Yeah, you got to own thousands of them with those characteristics, I guess. Yeah.
Exactly. So if you get rid of the fact that it could go bankrupt and hijack your entire plan, and you buy a basket of them, let's say 1,000 of the smallest companies like that, compared to 1,000 of the nicest large companies like that or something like that. When you look at the data and you break that up, which people like Ken French have done, you see a premium for owning these small, less nice companies. And depending how you cut it, it's basically the small value premium. For small caps, it's been about 2% a year over long periods, the 100 years of data we have. For value stocks, depending how you measure it, it's been a little bit more than that. But the magnitude is less important than the philosophy and the idea that, okay, not all stocks are created equal. And it makes sense that if someone's willing to take the risk of companies like that, they should demand a higher reward, right? Like whenever we take risk in life, we expect a commensurate return for it. So to your question about deviating from the market portfolio, why would I not just own the market capitalization weight of every single stock out there? It's because you might want to move some money from these large, nice companies to smaller and more value-oriented companies and pursue this premium that's existed for 100 years that I would say is logical, makes economic sense, and we have portfolios that can capture that premium. However, just like we were talking about the general investor timeline not lining up with academics, chasing premiums like value stocks over growth stocks or small cap stocks over large cap stocks is also super whippy and noisy and does not always happen on periods that people can stomach. So the last 10 years haven't been great for either the small cap premium or the value premium in the United States. And a lot of people love this research. There's Nobel Prizes won on this small value research. Like people go head on into it. They move their whole portfolio towards this approach. And you're like, well, you've omitted some of the most successful and largest players in our economy. I really wouldn't do that. Like there's still a big part of the economy. If you want the market return, own something that looks like the market and don't go too far into what we call tilting your portfolio away from the market. So for our firm, to answer your question sort of head on, we tilt a little bit towards some premiums that we believe over very long periods will outperform. We talk about it very little with clients. It's not a huge part of the drivers of their expected outcomes over time. For our clients, it matters a lot more like, hey, can we get $4,000 in your portfolio every month?
Yeah, did you contribute to your Roth IRA? And are you are you in the HSA and a high deductible plan? And those kinds of things are a lot more impactful.
Totally. I will say, you asked me earlier, like, what makes you tick? One of the issues I've been very frustrated with our industry in the last 5 years has been this shift away from investment excellence and towards just having an entire value proposition be financial planning. There are so many different types of financial advisors, many fantastic, many crappy. It's confusing to people because there are places that I would say, in the wirehouse brokerage world that have massive conflicts of interest that I really wouldn't want to send a friend or family member to go live in that ecosystem. But they have great advisors at places like that anyway. They're good people with good intentions at all different types of firms. So it's very confusing for someone that says, I want an advisor.
Go find an advisor.
And they just go find an advisor. How do they know what to do, right?
Right.
So it is very important that as financial planning has become a bigger component of most advisors' value proposition, I give that a huge A+. I'm really excited about that. It should be that way. And financial planning is an incredible tool for people to guide financial decisions. That said, only focusing on financial planning and letting the investment decisions or investment philosophy take a back seat and not matter as much, you might hire an advisor who has no idea what they're doing. And just because we can say, keep things diversified, low cost, and tax efficient, does not mean every advisor knows how to implement that. So what I've seen, especially as I launch my firm and I see prospective clients send me what they're doing at various places, be it some robo advisors that say they use index funds, but they don't really know how. It matters. Investment excellence matters. And so that's another thing that really gets me going. You'll see it if you read my blog, is that, just saying, again, you're low cost and use index funds and tax efficient, I don't believe it till I see it. And I see a lot of issues with the way the majority of advisors manage portfolios.
Yeah, the actual implementation. Yeah. So we talked a little bit about companies. How do you view fixed income and bonds? I know you've got a lot of experience in fixed income securities, bonds.
Yeah.
So how do you view bonds in a portfolio?
Yeah,
What is
question.
the purpose of bonds in a portfolio?
It's different than stocks. I mean, when you think about stocks and describe all the noise that comes with them and the reason people own them, which should be the same for everyone, which should be the growth of your portfolio, there's never a reason to, once you decide a philosophy with stocks, let's say you're going to own the market and slightly overweight value stocks. Let's say that's your approach. What would cause you to now deviate from that? I would tell you, don't time the markets. Don't try to forecast what's about to happen. So that's not going to cause you to change it. When, let's say right now, we're talking on Tuesday, March 11th, the U.S. market is down 10 to 12% right now, I'm guessing. I don't know where it is today, where it closed a few minutes ago.
In the ballpark.
Okay. And international emerging market stocks are positive this year. So we have a huge variance in the realized performance of various regions in the world. So do you want to go sell international stocks because they've done well and buy U.S. stocks because they've done poorly? And I would tell you no. Because that is the market now. The market has told us that the U.S. is less valuable over the last few weeks than it was relative to these other parts of the world. That is the market. So things have been reset, and it doesn't matter what it looked like before. In stocks versus bonds in your own portfolio, it matters a lot what weights you own things in, because that is determined by your ideal life. You go do a financial plan with Jeff, and Jeff tells you need to own 65% stocks and 35% bonds. When those deviate, you are now off track. Your appropriate risk profile is wrong. That's not the same in stocks. Stocks, when the U.S. goes down and the international stocks go up, that's just the new market. That's just where we are. So the reason why I say all this is that in bonds, not only might you be trading to rebalance, but bonds also have another unique characteristic, which is that they tell us a yield. Stocks don't tell you any useful yields. There's no stock yields.
Right.
People will try to sell you that dividend yields matter. They don't matter.
Yeah.
The only thing that matters is in the bond market, if you own investment grade bonds and you have a high, very, very high probability of getting your yield over time, that's information to use in portfolio design. You own stocks, you look at the historical rate of return, you say, I hope to get 8 to 10% over a long period, and I hang on for the damn ride. Not the same in the bond market. So what's different in bonds is that you actually do want to be somewhat strategic about the types of bonds you own, because they give you information about your expected return, not just over long periods, but also over short periods. So I wrote this piece at the beginning of the year. It was picked up in the Wall Street Journal. It basically said, yes, it's crap when all these people give all these banks give all these forecasts about S&P is going to do 18% this year. Nobody knows.
That was really good. Yeah.
Thank you. However, I do know that a 1-year treasury bill, which is risk-free, is going to I can give you down to the third decimal the yield you'll get. because they know exactly what you're going to get over 1 year. So not all forecasting is wrong or incorrect or stupid, but some types are really unhelpful and not productive. However, what investors need to know is it's all on a spectrum. And the front end of the spectrum where you actually can reasonably forecast things is the bond market. The far out one is the stock market. So in the bond market, when you have short-term bonds, you know your yield. And if it's investment grade, you're high probability of realizing that yield. If it's risk-free like a treasury, you're guaranteed the yield. As you move out to the core bonds, which are a very common thing to hold for clients, so Vanguard total bond, dimensional core bond, investment grade core bonds, very, very common, the most popular types of bond funds, those yields are not promised. So in 2022, while the yield might have said 2 or 3% at the beginning of the year, some of those bond funds were down 18% at one point during that year. So you're not guaranteed those yields over time. But because the mechanism that bond prices and yields are inversely related, if you own a bond fund and the price goes down, your forward yield is now higher because you're going to get paid income through time and reinvested in higher yielding securities. So unlike stocks, it's not all on faith. Bonds have math about how to work out your return through time. If you buy a short-term bond, you will realize your expected yield, or should expect to realize your expected yield over a shorter period. If you own a core bond, it may take a while. There's a rule to sort of double the maturity profile-ish of your bond fund. So if you buy a bond fund that has like a 5 to 6 year maturity profile, as long as you got about 10 years, you can get close to almost get exactly of the yield you started with. So where I was going was in the bond market, yields change shape. So sometimes a yield curve is normally inverted. That's what we typically have. It's about 80% plus of the time yield curves are normally shaped, which means longer term bonds yield more than shorter term bonds. I would say that is a classic trade-off. Do I want a lower yield but more predictability, or a higher yield but more variability around my investment outcomes over time? But sometimes yield curves invert, which is what until a few weeks ago or a few months ago, and now it's kind of oscillating back and forth, has happened where for the last couple of years, short-term bonds, like a 3-month bond or a 1-year bond, has yielded more than a 7-year bond. And why does that happen? Well, it's got to do with Fed policy and the way market participants react. But what you should know is that in your portfolio as an investor, there's some sandbox that you want to be playing in. You might say, I'm comfortable owning anything from 0 to 7-year bonds based on what my financial plan says I'm trying to accomplish. Well, if the yield curve changes shape and 3-month bonds yield a lot more than 7-year bonds, you probably want to shift some money into those shorter term bonds.
The yield curve helps you determine the maturity or the duration of the bonds that you own in your portfolios?
You got it. Which is, this research was done 40 plus years ago by Gene Fama that's called basically the term structure of interest rates. And absolutely, investors should vary the maturity profile of their bonds. Now, what's cool is that there's a couple companies, namely Dimensional Fund Advisors and Avantis, who both do this for you within some sandboxes. So one thing to do is you can own funds from those companies, and they will do that within the bands that they lay out in their prospectus. They're not very wide bands, but a little bit, compared to an index of a similar market. But advisors can also do this. So we will go sell core bonds and buy short-term bonds, or sell short-term bonds and buy core bonds for our clients based on the shape of the yield curve.
Yeah. So do you view bonds as defense or income or both in the context of a global portfolio? In other words, is it volatility reduction or is it income or yield enhancement?
My blanket answer to a question like that is always going to be, it depends. Like any financial planner, we like answering things that way. In reality, I don't do anything for yield or income. Every portfolio is a total return approach where if a client needs 5% to live their life, I don't care whether I get that from a bond paying me a coupon payment or me selling some off the top of an equity fund to get the money for the client. So we design portfolios with expected returns in mind, not income in mind.
Makes perfect sense. Yeah.
But I don't think they're unrelated either. Like, having bonds gives you more predictability than an all stock portfolio. And so my ability to generate a total return that I have some reliability around is clearer with some bond exposure. But I would say it's more defensive It helps you smoothen out the ride. Very few people are aware of what owning an all stock portfolio or a 90% stock portfolio can feel like. So it also helps people stay through. I mean, I will tell you, we work with a lot of 40-year-olds, and most of them are in something like an 80% stock, 20% bond portfolio. And it's often less stocks than they own when they started working with us. And I have to tell them, I was like, look, the last 10 years have been great for your Tesla and Amazon, Google portfolio. I get it. But like, if you want to work with us, we don't just think about the last 10 years. We look at the long-term investment journey of people that have been investing for decades and decades, people that were alive before we were and that are dead before I was alive. And the truth is that like, not only does history tell me a lot can happen, I don't know the future. Give me a good reason why the stock market can't go down 50%. It's done it before. Why couldn't it happen again? So the very fact that after 2022, as bond yields have risen, I love having 20% of a portfolio in a 5 or 6% expected yield from a core bond fund. That's a fantastic contribution in both risk and return to a balanced portfolio. But I will say a lot of people come to us having owned much higher torque portfolios, and I have to persuade them to our approach. Weeks like the last few weeks here are very helpful. You know, someone that started working with us a month ago and then had experienced this downturn, and maybe hopefully they're already in the 80-20 portfolio instead of a 95-5, they're really happy. But someone that started working with us 2 years ago, for the first year, might be like, shoot, Rubin, why
all these bonds?
Why all these bonds? They serve many purposes. Again, I'm less in love with the income approach. I really like people thinking about an integrated portfolio. There's a lot of various reasons to use bonds. The ones we haven't talked about would also just be taxes. So if someone's in a really high tax state, like a lot of our clients in New York and California, particularly, if you're hitting the top tier tax brackets in those two states, municipal bonds can make a lot of sense.
Yeah. So do you do the same thing with credit exposure? In other words, the riskiness of the borrower, or so you change the maturities based on the shape of the yield curve, or allow these managers to do it for you. Do you do anything different with credit, or do you just stay pretty high quality, or is there anything different in terms of the credit profile?
Great question. So basically as the deviation between something that's like a bond that's really not that risky and a bond that's risky, as that spreads out even wider, which will often happen in periods like 2008, 2009.
The stress. Yeah.
Exactly. Stress makes the disparity wider. Yeah, we do a little bit of it within the funds. So there is some research that says when that happens, if you can hang on, it does make sense to start overweighting the riskier parts of it, the lower quality things, as they deviate from the long-term sort of historical relationship. I'm not in love with going to load up on low quality bonds. If I want that sort of exposure, I'll go buy stocks.
Do the stocks,
I wouldn't say we do too much of that. I think the big takeaway to have for investors in the bond market is you really on their term, which is if all of a sudden 7-year bonds yield a lot less than 3-month treasury bills, you probably want to do something about it.
Yeah, makes sense. Yeah, let me ask a couple of financial planning questions. We talked a little bit about financial planning. The first one's just right back to your article a little bit. So how do you formulate financial plans using expected return? How do you come up with a return to put in your retirement income modeling?
Yeah, great question. Again, for us, while we have to hit the retirement tab on our planning software, we often tell clients, the client might be 40 or 45, and we're saying, look, we really need you to know that there's a ton of noise before you hit 65 or whatever the number is.
So it's an educated guess at best. Yeah,
exactly. Now that's not the same for someone that stopped working and is in withdrawal mode. And that's, we do a little bit of that, as I said, but that's something I know your firm probably does a lot more of. What I will say is that financial planning software is still super helpful to make high quality decisions together in short-term periods. So we have to use expected returns either way. And the way that we come up with those are for bond returns, it's the current yield. If an investment grade bond fund has an average of, let's say, a duration of 6 or 7 or average maturity profile of around that, that means I'm going to expect about that yield over that period. So that's a good proxy. That yield is a good proxy. There's information in the yield. For short-term
today,
bonds,
that might be 4 to 5%, 5.5%, something like that.
Yeah,
in today's environment.
A few weeks ago, it was probably 6, and now it's probably 5.5, 5.5.
Yeah.
Yep.
Yeah.
Now, the nice thing about planning software is when you lower that longer term yield, you also up the investment account balance, because as those yields have come down, client portfolios would have gone up, right? So there's some method to the madness, of course, but things are iterative in planning, and that's why it's helpful to, if you do hire an advisor, to work long term with them, because you want to see those updates through time. So for bonds, I would say bond yields are
The yields are a good proxy. Yeah.
Those are good proxy. For stocks, it's going to be the long-term historical average. What's really important is two things. One, I would say inflation. So you're not going to get the long-term historical average of stocks. If inflation is 10%, you're just not going to get it, because it doesn't look anything like the long-term average of inflation. Same thing with bonds. If inflation shoots higher, yields have to go higher. So it's always very important when you do planning work with an advisor to think about what they call real returns or after inflation returns. But in general, if I just kind of put that aside for a second, for stocks, you want to think about the long-term historical average. And if you really do the real work, it's the long-term real average.
Right.
And
after inflation.
For bonds, it's very similar. Exactly. Now then, as planners, we then want to say, do I want to show my clients their expected outcomes based on history? I would say maybe to start, but then I want to show them a slightly more conservative version, because I don't want to tell someone, hey, your money endows this lifestyle that you want based on history, and then all of a sudden future doesn't match history. No one knows what's going to happen in the future. We think it'll be somewhat close to the past as far as realized returns. But I would say after you do that work, you then want to say, we're going to knock off 1% or 1.5% off your expected return through time, because I just don't want to shock you to the downside. I do want to say one other important thing, which is a lot of advisors focus on not surprising clients to the downside. That is really important. It is also just as important that we don't surprise clients to the upside. That all of a sudden they say, I want to live this kind of life. And we tell them, I really don't think you should do that, because I'm using too low of an expected return. And all of a sudden they wanted to take a safari before they died, and they didn't get to.
Yeah, and they leave a lot of money and didn't live the life they would live. Yeah.
So it's also about living as big of a life as clients say they want to, within reason. And that's the art of financial planning. A lot of it is numbers and science, but a lot of it really is managing unknowns. And that helps to have an iterative process, and it helps to also accept that the general randomness and noisiness means it can't be a hard science in the way we talk about it with clients, and we adjust these conversations through time. But I really do think, like, as advisors, we want clients to live big lives. And so if someone says a goal, we want to make sure that we don't immediately jump to assuming they're going to run out of money. Like, we have to have realistic expectations and help them accomplish things that they want to accomplish.
Yeah, I think that phrase is the most important, realistic, because we don't know. There's a wide range of outcomes, and when we put expected returns in, I mean, that's the midpoint of a big, giant, noisy experience you're likely to have. I think it's a midpoint guess. Yeah. And of course, the paradox is if we use expectations that are too conservative, it might drive us to advice that has them in a lot more equities than they probably should have, because we're using lower expected returns, and vice versa. So I think realistic is really important. So the second financial planning question I have for you is, I've been thinking a lot about this a lot lately, and it seems to me there's sort of two schools of thought in doing financial planning or retirement income planning for sure. And one is, where you basically do liability matching. You say, okay, you've got your human capital, you've got Social Security, we know your essential expenses, and they'll basically immunize that with treasury bonds or Social Security and your human capital. And then your non-essential expenses could maybe be all in equities. So sort of liability matching. And then the other method, which is what we have used through most of my career, is, we build a comprehensive plan, and then we determine your need, ability, and tolerance for risk, and that drives the investment policy. Any thoughts on those two methods, or one better than another? I don't know if that even made sense the way I asked it.
No, I thought it was very articulate. They're both super reasonable. As you know, anyone that takes a portfolio management class or studies for, the traditional credentials in our industry, you got to learn about both. And immunization of a portfolio is a super important concept. I'll give you an example. We had a client sell a business 2 years ago, and he had a $4 million tax bill that was going to come up. I'm not risking anything on a $4 million tax bill. So about 9 months before it was due, we bought a treasury bill that matured basically the day before the tax bill was owed, and we immunized the portfolio to match that liability. I don't know anyone that should do it a different way. Right. You don't want to risk that.
Right.
However, if someone gives me a general idea of their life, so the other end of the spectrum now, the way you and I more frequently manage money, general idea of your life, general expenses, general goals. If you start immunizing everything, you're going to leave a lot on the table, right? If someone says in 9 years, I expect to spend $63,000, and I buy a treasury bill for $49,000 a day that matures exactly on that day that the year starts, and give them, there's a lot we could have done in those 9 years that wasn't a treasury bill. And treasury bills, basically, because they're the risk-free investment, there's some of the lowest expected return investments there are. And over 9 years, I believe I have a high probability of doing better than the risk-free investment and still getting your $63,000 you need to live. So for us, when someone doesn't have a very specific liability, like, say, a tax payment or a wedding that they really want to pay for.
Short and intermediate term. Yeah.
Yeah. And they really don't want any variability around that. Again, that also helps them sleep at night, which is important and has value that's not necessarily monetary. Liability matching makes sense for certain things, especially specific liabilities. Otherwise, we're not institutions. That's an institutional style investment concept.
Right.
And I would say most investors, if they have a good planner or they have their head around what they're really trying to do and they know how their plan looks in the software, you don't really need to immunize. You can still have a really high probability of success and not leave returns on the table.
Yeah. And actually more optionality.
Correct.
Potentially more uncertainty, but you get compensated for the uncertainty, but also more optionality, because it's hard to forecast what we're going to feel 15 years from now and what we're actually going to need 15 years from now, or what. Yeah.
It's a great comment. This idea that markets work. If I also told you, hey, you can guarantee yourself something today, in 9 years, your outcome, you should expect that if markets work, that's not going to be the highest expected return asset, right? Or that's going to give you additional options. You've locked something in, there's a small benefit for that. If you need it, great. But you should assume that in a well-functioning market, there are better options out there if you don't need to lock something in.
Yeah. So the name of your blog is Fortunes and Frictions. Tell me what you're trying to communicate with the title.
So the blog's about 3 or 4 over 3 years old. Coming up with a blog name's hard. I'll say that. I had a couple of people help me and people think through the language, but essentially, I talk a lot about frictions. To me, earlier we talked about sort of low cost, index style, passive, market-based, globally diversified, tax-efficient portfolio, and how hard it is to actually do that. And I would say that's because there are frictions to the knowledge we have about the best way to invest and actually having that investment journey. Frictions include, I got accounts all over the place. My buddy from college, he's my advisor. I want to leave some money with them. I don't want to stress that relationship. All the various reasons, people always find a way not to do what we know we should be doing. So frictions is something I talk about a lot. And the goal is a frictionless investment experience. We'll never actually get there. But things like a good philosophy, the right technology, having the right accounts open, potentially a great advisor, those can all help remove frictions. And then fortunes is because when we talk to clients, and I'm sure your firm is the same, I ask you, what's a perfect day look like? What does being fortunate or having a fortune look like to you? For me, if I can wake up in the
morning, it's more global than just the balance sheet, it sounds like.
Exactly. And it's more ephemeral, and there's more things that go into it than numbers. When my brother, I was married at one point, and when my brother interviewed us to be our wedding officiant, he used this old New York Times script about how to really understand your partner. It was some 30 questions about love or something like that. And one of the questions he asked was, what's a perfect day look like? And my ex and I went through this process with him. And what's per day look like? To me, I was like, I wake up, I drink really good coffee. I love fresh squeezed orange juice. I do the New York Times crossword. There's all these things that I'm like,
Right.
I freaking love doing these things. And not everybody else does.
Right.
That's not their
It's
perfect day.
unique.
That's my
Yeah.
perfect day. And
Yeah.
so it was a cool exercise to do. And so we do it with clients now. We ask them, what's perfect day look to you? And people say, I walk my daughter to school, right? Or I get a chance to talk to my mom. And those things are important. They don't always have to go into a financial plan, but sometimes they do, because a perfect day might be, hey, in 5 years, my perfect day is we're taking 2 years off and we're moving to New Zealand.
Yeah. It may take some underwriting, financial underwriting.
Exactly. Yeah. So I write about it a lot. It's a big part of an ethos of our firm and what we stand for, which is I don't know your fortune until I ask you. And so for me, a great investment journey and planning journey deals with identifying your unique fortune and removing frictions to getting there, because it's typically not as hard as people think, but the ecosystem of finance and Wall Street will try to make it hard on you because they want your fees.
Make it more complex.
Like they want your fees, they want to make it complex. That's how they get paid. And so I love this idea of your unique fortune and then remove frictions to get there.
Yeah, very cool. Well, I want to end on a couple of soft things here. And one of them is right from the blog. So I'm going to read this quote from the blog, and then I just want you to comment on it. It says, the time value of money equation transcends finance. So hit rock bottom with your present value as quickly as possible and find a way to pursue higher returns on life than you had before. It's the only mathematical way to recover your previous trajectory. And I know you're incredibly transparent and personal in your blog.
Yeah.
And so that one was a very personal one, I recall. So tell me what that means. What does it mean to hit rock bottom as quickly as possible?
Again, we work with slightly younger people and most advisors. You want to take these risks in life when you're younger and can afford mistakes. It's much harder to afford mistakes when you're older. The classic math behind that from an investment standpoint is that if you're withdrawing your portfolio every year, well, let me take a step back. One thing that a lot of people don't understand about investment returns is that it doesn't matter when you get them if you get the same ones, as long as you're not withdrawing from your portfolio. So if this year I get 50% and next year I get minus 10% and the next year I get 4%, do those in any order and you get the same outcome. So there is no challenge there. For a lot of our clients, that is the case. They're not withdrawing their portfolio. The classic retirement conundrum comes when you are withdrawing in your portfolio. If you have $3 million and you pull 150 grand every year to live, if the market goes down 30% one year and you pull your 150 out when it's down, and then it comes back, you didn't have all your money in there. Yeah. Whereas if it went up and you pulled 150 out and then it went down, you pulled out at a good time. So The math does change once you start withdrawing. Those sorts of things, like errors or big downturns, matter more later than earlier. So there's a lot of people think about their career, take your risks early. The book you're referring to was that was related to a very personal part of my life. That was very challenging. I'm 41, I'm young-ish. And I'm so glad it happened. If it was going to happen earlier than later, it was related to my divorce, right? Like I feel that I hopefully now will have another chance maybe. And my partner, my ex, will have a chance to meet someone that was a better fit, who will bring out the best in us that we didn't find with each other. And I think that's great for both of us. So that was what the blog was.
That was kind of the concept. Yeah.
Yeah. The concept is like, this would be so much harder if we were a lot older, and acknowledging that it's actually very similar in finance.
Yeah, makes sense. Well, and it's also, sometimes we learn the most through the most difficult times. So, you don't feel like when you're going through it because it's, it's hell, but oftentimes, you do grow the most through some of the most difficult times.
I love that, Jeff, because imagine if you learn so much towards the end of your life. In many ways, it's a lesson wasted.
You don't have a lot of time to compound that learning.
Exactly.
Where now you've got a lot of time to compound what you've learned. When you were talking too, I was thinking about when you were talking about if you didn't add money, it didn't matter, the sequence of returns. If you didn't add or were taking money out, it didn't matter. If you're taking money out, it matters a lot. And the the downturn, how you can sometimes profit from the downturn. I was sort of thinking about 2022 in the bond market. It was bad news for my clients that their fixed income was down 12 or 13%. But the good news is now I'm getting a 5% yield that I'm going to that is now the expected return of the bonds for the next 7 or 8 or 10 years. So it's kind of a an ironic way to think about it. So before we wrap up here, how can people find you, follow you, learn more about you? What's the best way to keep up with your stuff?
Yeah, thanks. You can subscribe to the blog, Fortunes and Frictions. And then I write fairly frequently on LinkedIn as well.
Is that just fortunesandfrictions.com?
It is, yeah.
Okay.
And then I'm on Twitter as well, but I'm not super active. It's kind of a tough place to be these days, but LinkedIn is more my ecosystem.
Okay, so they could find you, Rubin Miller, on LinkedIn.
Yeah, Rubin Miller on LinkedIn, and feel free to connect. Yeah, thanks.
Yeah. Well, very cool. Well, is there anything that I didn't ask you that you'd like to talk about, or was this? I mean, you probably had no expectation, so you didn't know we were going to talk about it.
Yeah, no, I really enjoyed this. I can tell you're probably a very thoughtful advisor, and your clients are lucky to have you. And it's cool, like in this day and age, you can meet advisors. We oftentimes will focus on different people, so they're your ideal client profile or whatever. So there's a lot to learn from various advisors, and so I've enjoyed the conversation and. Wish you the best of luck.
Likewise.
Yeah.
Well, tell the audience also where they can find your firm.
Sure. So just peltomacapital.com. Again, it's myself, Rachel Levine and Emily Moran. We're a fantastic little boutique. We're having a blast. And, especially for those younger folks that are looking for financial engineering of their life, I think our content or reaching out to us, or whatever, is probably a useful conversation. We're quite good at it.
Yeah. Terrific.
Yeah,
well, thank
thanks.
you, Rubin. This was tons of fun. And thank you guys for joining us. Hope you found some value like I did. Please check out the shows. You can certainly check out past episodes at all the normal streaming services. Give us a rating if you liked it, or send me some comments. Regardless, you can also reach me at moneyandmeaning@tandemgrowth.com. So thanks and have a great day. See you guys.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.